Hey everyone, and welcome back to the channel. In today's video, I'm going to be looking at Foot Locker stock, and I'm going to be breaking it down using the investment process that helps me find low risk, high return investments. From my personal experience, the best way for you to learn how to research and analyze businesses that you could potentially invest in, the best way for you to do that is to see real life examples of stock analysis so that you can find out what are the most important components of stock analysis, and then you can take those components and apply it to any business that you're looking at, because of course your businesses that you're analyzing are not always going to be the same businesses that I'm analyzing. So I'm going to be trying to make these stock analysis videos a regular part of the channel again, so you can look forward to seeing many regular stock analysis videos on this channel once again. And if that's something you're interested in and you're seeing this for the first time, then make sure you hit subscribe and become a member of the team. Now, of course, just before we get started, I did just say that these are examples. These are not to be taken as recommendations to buy, hold, or sell a stock. I'm not a financial advisor, and I'm not giving recommendations or specific financial product advice. This is just an example of how you can apply the investment strategy that I use to consistently outperform the market. So with that said, leave a like on the video if you enjoy, and let's jump into it. So before we jump into the numbers and looking at the management and the economic moat and those sort of things, we first want to introduce Foot Locker as a business. We first need to understand an overview of what they are, what do they sell, and who do they sell them to. So Foot Locker Inc. is a leading global retailer of athletically inspired shoes and apparel, and it sells those through its 3,221 stores, which are primarily in malls, but also in high traffic urban retail areas. And Foot Locker has stores like this all over the globe. They're primarily based in the United States and Canada, but they have many stores in Europe, Australia, New Zealand, and they just recently opened their first 5 stores in Asia. Foot Locker has 2 reportable segments, and they break down to their athletic stores and direct to customers. So their athletic stores segment comprises of all the physical stores where people come and buy shoes and apparel from those stores. And then they have their direct to consumer or direct to customer segment, which is their online presence. So this is where people shop online on one of either the official Foot Locker stores or one of their smaller subsidiaries, such as Eastbay, which is another online apparel retailer. And they buy from those stores, and Foot Locker ships them out directly from their suppliers, from their distributors. And those are the 2 reportable segments that you will see on the income statement and on the financial reports that Foot Locker presents every quarter. So now that you have a brief understanding of what Foot Locker is as a business, let's take a step back and have a look at the industry in which it sits. And this is really important because we need to understand how big of a component Foot Locker is in their industry, so that we can see if they can grow their market share in that industry and take revenue and customers from their competition. And we also need to see how that industry is trending over time. We always want to be investing in industries that are expanding, that have more revenue up for the taking, and have more customers every single year over the long term. And that means it's going to be easier for Foot Locker to gain more customers because there's new entrances into the market, and it's going to be easier for them to generate more revenue and of course more profit for the owners, us. So the primary industry that Foot Locker sits in is the athletic footwear industry. But let's first look at the footwear industry as a whole. According to Credence Research, the global footwear market produced revenue of $222.4 billion in 2017 and has an expected growth rate of 3.1% from 2018 to 2026. So the global footwear market is one that is growing over time, but it isn't one that is growing quickly. It's growing very slowly, and that's probably to be expected. It's not a market that has new customers coming in all the time. It's not a brand new industry. It's not a changing industry. So we can expect that it's going to grow at around the rate of inflation, somewhere between 2 or 4% per year over the long term. Now, of course, within the footwear industry, we have athletic footwear, which is where Foot Locker sits, and then we have non-athletic footwear. So let's zoom in on athletic footwear and have a look at how that industry is changing over time. In 2017, global athletic footwear sales were $37.8 billion according to Credence Research, and they anticipate that there is going to be a compounded annual growth rate of 5.3% up to $60.5 billion by 2026. So let's now move on to looking at the economic moat that Foot Locker may or may not have. So an economic moat is some kind of long-term competitive advantage that a business has over its competitors. We're looking to the business to see if they have anything intrinsic within their business that is giving them some kind of advantage over other companies, that is allowing customers to be attracted to them over the other businesses in that specific industry. So we're going to first look at this qualitatively, and the strongest qualitative moat that Foot Locker has is their branding and their innovation. Foot Locker is very focused on elevating the customer experience, taking it above and beyond the other footwear retailers in their industry. And they're doing this in many ways, and they're innovating in the space, which is encouraging more customers and tapping in to that youth culture, which is a very central component of the Foot Locker business. One of the ways that they're doing this is through their new iOS app called The Hunt. The app lets customers use geo-targeted AR clues throughout cities to find limited edition footwear and other products. And this app is just one of the many ways in which Foot Locker is trying to stand out against its competition and draw in more customers, because everyone knows that retail is a very tough business to be in at the current time, especially with Amazon gutting many of the businesses in the retail industry. So the businesses that are going to survive in the retail industry and the ones that are going to thrive over the long term are ones that can innovate and provide something on top of just the traditional retail experience. And Foot Locker is doing a very good job at attempting to tap into the youth culture and target these specific customers. Moving on to have a look at the numbers now, we can see that over the long term, their growth is fairly slow, except in terms of their earnings per share. Sales growth is somewhere between 3 and 5% per year. We've got equity growth at somewhere between negative and 3%. Free cash flow growth is very inconsistent. And we have earnings growth, which is 35% over the long term. However, that is primarily due to share buybacks rather than a decrease in expenses. Equity isn't growing that much because they're using a lot of their free cash flow to return cash to shareholders. And they do this in two ways. They pay a dividend, and then they're also using the rest of their free cash to buy back stock. And this is certainly not a bad thing, but we need to ensure that they're generating a high return on those investments. So with a dividend, if you're getting paid out a dividend, you need to take that money and find another investment for it. So I would rather invest in a business that doesn't pay a dividend, but can reinvest those free cash flows and produce even more free cash flow. And in terms of their buybacks, that can be a good thing. It increases the value of the shares you hold, as long as they're buying it at a value that is under intrinsic value. So if you can determine, or if you decide that you think that they are buying back stock at an undervalued price, then it makes those buybacks valuable. The next part of our analysis is to look at management, and we need to assess management under two lenses. We first need to look at their integrity to shareholders. Are they being honest and transparent in their communications to us? And then we need to look at their skill as management. Are they good at investing within the business? And are they managing their debt properly so that we're not going to lose our entire investment? So let's just zoom in on their investment in capital. And we can look at this by looking at the ROIC, the return on invested capital. The long-term ROIC is positive since the global financial crisis, with a 10-year average of 12.26% and with a 5-year average of 13.78%. The long-term trend in ROIC is strong. However, in 2017 and 2018, they have underperformed their long-term historical average. So it means that we would want to see that trend sort of reverse. We'd want to see that their ROIC improves over the next few years rather than continuing to be underperforming their long-term average. Foot Locker also has very low levels of debt, with a current ratio of 3.3 and a debt to equity ratio of 0.5, which means that we can be very confident that we're not going to lose all of our money in an investment in Foot Locker, and it means we don't have to worry about a bankruptcy from not being able to pay debt. It means we can entirely focus on whether or not they're going to be able to grow their profits in the future, or their profits are going to go down in the future, or if they're more or less going to stay around the same over the long term. The final part of our analysis is to look at the intrinsic value. We need to work out how much are we going to get back from this stock, and therefore how much are we willing to pay for it. And one of the ways we can do this is by using a value matrix, where we take a range of future PE ratios and a range of potential growth rates of earnings into the future. And the value matrix can tell us what return we're going to get based on each of those growth rates and each of those PE ratios, and of course, based on how much we pay for the stock. At the current price of $61.90, you can see that there are not many high sort of outcomes for this business. You can see that if they grow very slowly in the 0 to 2.5% range per year over the next 10 years, then there's a chance that your investment could be negative. And at the top end of that range, we have 6.78% per year if they have a PE of 20, but they grow at 2.5%. Now, if they only grow at 2.5%, we have to be realistic and understand that they're probably not going to have a PE of 20. They would more likely have a PE of somewhere between 10 and 15, which means that it is not a favorable outcome. You can see that we would have to assume much higher levels of growth and high PE ratios to get anywhere near a return that we would be happy to receive over the next 10 years at the current price. Now, if the price was $30 per share instead of $60 per share, which is a 50% discount from the current price, you can see that with only growth of 5% per year and a 15 PE, we would achieve a return of about 15% per year from the stock price appreciating. And then on top of that, we would receive their dividend, which at the moment is between 2 and 3%. So that was some of the major parts of the stock analysis research that I did on this company over the past few weeks. However, if you want to hear my full thoughts and you want to get a downloadable copy of my full stock analysis on this company, then you may want to consider becoming a member of the Learn by Example platform and community. Members get access to new stock analysis reports and 60-minute presentations every 14 days to help you learn to consistently find low risk, high return investments in your own research, as well as our private Facebook community where you can participate in Q&A live streams, discussions, and more. Foot Locker was the latest company that I analyzed and added to the platform, so if you want access to that, all of the past reports, all of the future reports, and lifetime access to the Facebook group, then you can click the first link in the description below to get lifetime access. But I hope you guys enjoyed this one, and I'll see you in the next video.